John Paulson's name became legendary because of one trade, the short of the U.S. housing market in 2007 and 2008. Before that moment, Paulson was respected in hedge fund circles, but largely unknown outside of them. By the end of the financial crisis, however, his bet against subprime mortgages had turned into one of the most profitable trades in Wall Street history. He made over $15 billion for his fund, cementing his reputation and making headlines around the globe. This is the story of how Paulson saw what others ignored, how he structured the trade, and what lessons it holds for investors today. Paulson was born in Queens, New York in 1955. He studied at New York University and later earned an MBA at Harvard Business School. After working at Bear Stearns and other firms, he founded Paulson & Co. in 1994 with a small amount of capital. For years, the fund produced steady, respectable returns by focusing on event-driven strategies like mergers and acquisitions. Nothing in those years suggested that Paulson would soon engineer one of the most audacious and profitable trades in history. But his careful study of financial markets and his willingness to think independently laid the groundwork for what came later. By the mid-2000s, the U.S. housing market was booming. Home ownership rates were climbing, housing prices had surged, and Wall Street was generating enormous profits by packaging mortgages into securities. Many believed housing prices would never fall on a national scale. Subprime mortgages, loans made to borrowers with poor credit, were being bundled into mortgage-backed securities, MBS, and often rated as investment grade by rating agencies. Investors around the world snapped them up, believing they were safe. But beneath the surface, danger was building. Lending standards had collapsed, and banks were handing out loans to borrowers who had little chance of repaying once introductory rates reset. Adjustable-rate mortgages offered low payments at first, but would spike higher later. Mortgage brokers often ignored risk because they could quickly sell the loans to Wall Street. Rating agencies gave high grades to securities they barely understood. The entire structure rested on the assumption that home prices would continue rising. Paulson and his team began digging into the details. They studied loan documents, mortgage pools, and the assumptions behind mortgage-backed securities. What they saw alarmed them. Many loans were of shockingly poor quality. Borrowers lacked income verification, down payments were tiny, and teaser rates would soon reset. Paulson concluded that default rates would surge as soon as the housing market cooled. Because housing prices had been rising for years, he believed a reversal was inevitable, and when it came, the highly leveraged mortgage market would collapse. The challenge was figuring out how to bet against it. Shorting individual home builders or banks was one option, but it didn't provide direct exposure to the weakest link, the subprime mortgage bonds themselves. The breakthrough came with credit default swaps, or CDS. These instruments allowed an investor to pay a small premium each year to insure against the default of a bond. If the bond performed, the premium was lost. But if the bond collapsed, the payout could be enormous. Paulson worked with investment banks, including Goldman Sachs and Deutsche Bank, to buy CDS protection on subprime mortgage securities. In essence, he was insuring bonds he didn't own, a way of betting directly against the mortgage market. The premiums were relatively cheap at first, because few believed the bonds would ever fail. That allowed Paulson to build huge positions at relatively low cost. As defaults rose, the value of his CDS positions exploded. At first, his investors were skeptical. Many questioned why the fund was paying millions in premiums year after year on insurance against what seemed like an impossibility. Some worried he was wasting capital. But Paulson held firm. His conviction came not from opinion, but from research. He had read the documents, run the numbers, and understood that the system could not withstand even a modest downturn in housing prices. By 2007, cracks were forming. Subprime lenders like New Century Financial collapsed. Defaults began rising. Housing prices peaked and started to fall in many areas. By 2008, the system was unraveling. Banks that had packaged and sold subprime securities were suddenly on the hook for massive losses. Bear Stearns collapsed in March, and Lehman Brothers followed in September. The financial crisis spread across the globe, triggering one of the worst recessions in modern history. For Paulson, the disaster was a windfall. His fund reportedly made over $15 billion in profits in 2007 alone, with Paulson personally earning more than $4 billion. Investors who had doubted him now hailed him as a genius. The trade became known as the greatest trade ever, immortalized in books and films about the crisis. But the story doesn't end there. After the subprime short, Paulson faced a new challenge. What to do next? Investors poured money into his fund, swelling its size. He launched new strategies and made big bets in areas like gold, banks, and even pharmaceutical companies. Some trades worked, but others failed badly. His performance after 2011 declined sharply, and billions in assets left the fund. The very fame that his subprime short created also set expectations that were impossible to maintain. Still, his housing bet remains one of the most remarkable examples of asymmetric risk and reward. By paying small premiums, he positioned himself for massive gains if the crisis unfolded as he expected. He sized the trade large enough to make a real impact, but structured it so that his downside was limited to the cost of premiums. It was a textbook case of turning a low-probability, high-impact scenario into extraordinary profit. For today's traders, there are important lessons. First, independent research is invaluable. Paulson wasn't swayed by consensus. He looked at the data and trusted his analysis even when it was unpopular. Second, structure matters. Finding the right instrument to express a trade can mean the difference between a small gain and a fortune. Third, conviction must be balanced with patience. For years, his bet looked wrong, but he stayed the course until the thesis played out. John Paulson may not have maintained stellar performance after his famous trade, but his subprime short remains a defining moment in Wall Street history. It shows that with research, creativity, and discipline, it is possible to see what others miss and to profit when the world turns upside down. If you've enjoyed this deep dive into John Paulson, like the video the way he liked shorting subprime mortgages, and subscribe for more Wall Street stories. And remember, this is not investment advice. Invest at your own risk.